Stock, Leggett Platt. This is part 2. We're going to go deep into the business and the financials. Part 1 was more of an overview. We mentioned quite a lot over there. Look at that video, really important. Nevertheless, this is for entertainment purposes only, and let's get started with some of the more technical aspects of the business and the numbers. Okay, Carl Glassman, so he's the Chief Executive Officer. He's appointed in 2016, but he's been part of the company since 1982. So a really strong positive for the company, someone who presumably knows the ins and outs of the company, different parts of it. That's really positive. Same thing with the President and Chief Operating Officer, being part of the company since 2000. CFO, much less. However, he does clearly have some experience. He was CFO of a segment of Dow Chemicals, so that's at least a positive. Now, the Executive Vice President, and specifically the President of Specialized Products and Furniture, Flooring, and Textile Products, that's quite a mouthful. So he was appointed in January 1st, 2020. So sadly not that long, but he does have 30 years of experience at Dow Automotive Systems, and that's really important because Specialized Products, if you watched our last video, contains the automotive segment. So clearly someone who's going to be useful in this position. Now, the General Counsel was appointed in 2011, so not that long. However, he's been part of the company since 1987, and so someone who clearly knows quite a bit about the company, what they're going to need, different issues in their past, so a positive. And the Senior Vice President, Corporate Development 2016, but he's been part of the company since 2002 in different ways, so also useful, I think, as someone who, knows what's going on. Okay, so let's just start going into the 10K and looking at some of the details now. So sales increased 11% in 2019. Sounds great. However, organic sales were down 3%. So what's the discrepancy? Well, it was because ECS, that foam mattress company they bought, made up for it. There was 14% that was added to sales, and so it looks like they added to sales when in reality their sales from the company without this acquisition were really going down. So already this is a pretty big red flag. Now let's look at some of the legal proceedings. Okay, so this is pretty interesting. So they have an issue with manufacturers of mattresses in China specifically, and they are dumping. So what do companies do when they're dumping? So pretty much they will do two different things. One thing is they will, let's say it costs $1,000 to build something, they'll sell it for $800. No one can compete with them. It's impossible to compete with them. They're losing money. However, their competition is just going to run out of money and they're going to die, and then this company that's dumping will then increase their price and make a profit, and they won't have competition. That's one kind of dumping. Here, presumably what's happening with China is subsidizing these manufacturers. So let's say it costs $1,000, they're selling it for $800, and the Chinese government is giving them $400, and so in that way they are cheating Leggett Platt, because Leggett Platt doesn't have that subsidy, and so these companies are selling for less than fair value, and there are duty rates for these types of issues made by presumably the Department of Commerce somewhere between 57% and 1,732%, and I assume this depends on the mattress and the manufacturer and different things like that, but this is affecting clearly a lot of companies, and this company's taking it seriously, the government's taking it seriously, and that's pretty good. Now in November 2019, this was decided because the company was materially injured, right, from these importers, and it'll be re-examined at the end of 2024, whether these import duties stay. But in the meantime, this will at least protect the Leggett Platt at least a little bit. Now, when we look at a few more issues of dumping, right, we have foreign competitors, and what are they dumping? Now, instead of dumping mattresses, they're also dumping inner spring. So the springs that go in the mattress, of course, now much lower tariffs here. We're talking about 100% to 250% roughly. But once again, clearly taking it seriously. And then, of course, though, we have anti-dumping duties on the imports of steel wire. So, all these different segments that Leggett Platt are dealing with. Here it's from 1% to almost 800% of tariffs. And this was decided in June 2019 that there was going to be a third sunset review. And so, they'll have to decide what's going on there. And so these things constantly are being updated, changed. But it is important to see how many foreign competitors there are, how much they're competing on price, specifically with, companies who are being helped by their countries to help produce these things at lower than fair value, right? So that's what this company is competing with. It's a pretty intense competition, but clearly the government is taking it seriously. Now, there's a real estate sale that's presumably going to happen in 2020, and they're going to make $30 million. So that's a positive. It's worth keeping a mental note about, I suppose. Now, in terms of the segments and how they do in terms of sales, so we can see 2018, 2019 residential products increased by a huge percent. That's from the foam mattresses, presumably, but now we can see that it added $600 million worth of sales, roughly speaking. And in terms of industrial products, so, they're talking about the springs and things like that, that went down. Furniture products, that went down, $100 million. That's pretty substantial. Specialized products, stayed pretty much the same. And so if we looked at just these segments, once again, we're seeing an improvement. However, it looks like everything's going down, and it's, from my perspective, quite negative. Now, if we look at some of the details mentioned in the 10K, so they mentioned, for example, the furniture products, yes, they decreased by 8%. However, that was because they exited fashion beds, right? We mentioned in our last video that they weren't selling well, they cost too much to make, and also there were planned declines in home furniture. However, there was growth in work furniture. So in a certain sense, assuming you're trusting them here, it almost sounds like all of their loss, this decrease in furniture products, almost sounds like it was primarily intentional. And in fact, they are getting growth in work furniture. And so it's kind of like a positive sign to the furniture segment. I'm not sure how true this really is. You have to take everything with a little bit of a grain of salt. But they're making it sound like furniture products is doing better than, what is represented so far. Now, the earnings before interest and taxes, right, that increased $24 million, and that was primarily due to improved pricing and lower restructuring costs. So that happened, $10 million in 2019 versus $15 million in 2018. And so these costs, it's really important to understand that these can directly affect the outcome at the end of the day. It's only a $5 million difference, and so obviously the $19 million is presumably from better improved pricing, and that's what that's how their earnings before interest and taxes improve so much. So it's really important to understand that as much as sales can go down, and that to me is not a great sign, because if they keep going down, how much can you really improve price? Improving price is only a temporary measure. And same thing with lower restructuring costs. You can't just keep lowering it each year. I mean, obviously you should keep lowering it each year, but I'm saying, eventually $10 million is going to run out. There's only $10 million you can really add to your earnings before interest and taxes. It's kind of a meaningless expense as far as I can see. Okay, so now if we look at industrial products, we can see that sales decreased by 10%. That's not great. And that was pretty much just because there was weak trade demand for steel rod and wire, right? What can you do about that, I suppose? In terms of the selling price, so that increased and that added 3% to sales. So, a positive. So volume was down 13%. However, the price improved it by 3%. And so at the end of the day, sales decreased by 10%. Nevertheless, after all of that, the earning before interest and taxes increased by $29 million anyway. Why? Well, they have lower raw material costs. So that, that's also important, and that is a real thing. Of course, those things can change. And so, this earnings before interest and taxes can flip on its head if just because the raw material costs, you can go from an increase to quite a substantial decrease. Okay, now in terms of specialized products, those are up 1%, and that's from the PHC acquisition, and so those are the hydraulic cylinders. Now, once again, we're seeing organic sales were flat, and yet nevertheless we had an increase simply because of an acquisition. That's not the right way to get increases, so it's a little bit scary. Now, their earnings before interest and taxes decreased by $18 million, even though their sales were up. So it's kind of funny. Where their sales go down, their EBIT goes up, and where their sales go up, it looks like their EBIT is going down. It's such an odd thing. Nevertheless, the higher sales were offset by higher operating costs in aerospace and hydraulic cylinders, negative currency, and of course, investment to support future growth in automotive. Okay, now I want to really mention this negative currency, and we'll have to come back to it later, but this is important, and that's why the earnings, it's so tricky to gauge from year to year sometimes, and it's going to be trickier in this coming year. Okay, so let's just look at their accessibility to cash, because this is pretty important. So they have cash and cash equivalents of about $250 million, which is pretty good. And they have another $250 million that was utilized in 2019 to reduce debt. And in 2018 and 2017, they similarly used, almost like $500 million between them at little to no added tax costs, which is pretty impressive. And so presumably they will continue doing that in 2020, and we'll talk about that a little bit more when we get to their first quarter. Okay, so now let's get deeper into the numbers in terms of the financials. Okay, so when we're looking at the foreign subsidiaries, right, they look at these as long-term commitments, And so these are pretty much total assets, net total liabilities. Clearly, we're talking about quite a lot of money here, almost $750 million, or pretty much $1 billion actually, in terms of Europe, China, and Canada, in terms of foreign investment. So that is quite a substantial amount of money that technically, in theory, they have access to, but presumably not. We have no idea exactly how tied this money and these assets, I should say, specifically whether they're permanent capital or notes or whatever type of investment this might be. So I'm not entirely sure how much they can really take out, but we'll talk about it a little bit later, what they're planning to take out at least. So pretty impressive, in terms of cash access. It's, it is what it is. It's hard for me to tell you exactly what they can take out, because if they take out too much, all these businesses could fail. So it's really hard, but clearly they have, it looks like somewhere like $500 million worth of access, which, let's be mindful of it when we're going to talk about their expenses. And so let's just take a look at their expenses and see what's happening in the next year, right? So in terms of long-term debt, you can see that their total long-term debt is, $2 billion. That's an enormous amount of money. Luckily, next year, we're talking about only $50 million, right? That's tiny. That's very manageable. Now, in terms of their interest payments, we're talking about $75 million. That's not bad. In terms of operating leases, so $50 million, they're not going to be able to get out of that, I wouldn't imagine. Now, in terms of purchase obligations, so, they have $500 million worth of purchase obligations. I don't know exactly if they can really get out of that, if they can delay those. I have no idea. Presumably, they're already obliged to, they can't get out of these. So, when we were talking about before that they have access to cash, and whether just in terms of their current access to North America or in terms of the foreign stuff, we're talking about $500 million, and so they can presumably cover the next year in terms of expenses if they were able to sell nothing, and assuming that they cut their dividend, which is, I think, something like another $250 million. So, to my perspective, that's a really good sign, at least for the next year, and presumably, by the next year, everything in terms of the economic world will have righted itself, or be in a very strong position to right itself. So to me, that's a strong sign. You'd wish they had a lot more money and would be able to last a lot longer. But nevertheless, to my mind, this is a pretty good sign and a pretty good situation, and they're not going to go belly up all of a sudden, but it is a little bit scary. Okay, so in terms of credit losses, so they're talking about how they have reserves on their riskier customers. So they have, a $16 million reserve. It's not a lot, but it's also not a little. And in terms of in the past, they had less than $2 million worth of expenses associated to bad debt, pretty much. So, their customers seem to be pretty well off. $60 million seems to be a pretty good buffer. We'll see what happens in the coming year. But so it's, that's a positive from my perspective, taking things very seriously in terms of, their accounts and their customer accounts. Okay, so let's look at net sales. So we can see it just seems to be going up 2017, 2018, 2019, continuously going up. However, in terms of gross profit, you can see 2017 to 2018 pretty much stayed the same. And that's because although they added $300 million to net sales, they also added that to the cost of goods sold. So that's not great. However, the addition in 2019, those net sales were presumably and primarily from the foam mattress company, right? That's $500 million we mentioned was added from the foam mattresses. And luckily, in terms of cost of goods, it has a lower cost of goods, and so, their gross profit increased with that additional amount of sales from this new company. Now, selling and administrative expenses, of course, those continually cropped up for all of them, even when even before the foam mattress 2018, they added to selling and administrative expenses, presumably just selling more stuff. There's more expenses. I suppose that makes sense, and you get a new company in 2019, that'll also increase those types of expenses. Nevertheless, when we look at the earnings from continuing operations before interest and income tax, so we're talking about 2017, it was up, then it went down 2018, then it went up to 2019. Of course, when you look at net earnings at the end of the day, from 2017 to 2018, it did go up, which is not, obviously in terms of interest and income tax, it kind of flips this picture around a little bit. And of course, 2018 to 2019, it goes up once again. So, it depends how you want to look at it. At the root core of the business, sadly, it's fluctuating. 2017, 2018, it's not a good sign. It seems like the business is stagnating. Even if they're getting more sales, they're not able to make more money. That's a little bit scary to me personally. I don't know what to say other than that. Maybe that was like some odd year for the price of steel, just because the inner springs make up so much of the mattress. I have no idea. It's really hard for me to tell. But, to me, it's a little bit scary. Even if their net earnings keep going up year by year, the central business, and that's, to me, the more important part of this equation, it's a little bit stagnant. Okay, and we look at assets. So in terms of cash and cash equivalents, we already mentioned this. They have $250 million total receivables. So they have $600 million waiting to get paid by their customers. And in terms of goodwill and other intangibles, this is a massive jump in 2019, and this is presumably part of, or primarily because of their purchase of the ECS, the foam mattress company. So when we look at 2019, right, we're talking about 1.4 billion plus $700 million. So we're talking about $2.1 billion of goodwill combined with other intangibles. And when, the difference between that and 2018 is $1.1 billion. So that is a massive amount that was added. And presumably that can't all be from the foam mattress company, that increase. So I'm a little bit confused personally. I think we're about to see that it is primarily from that. But, nevertheless, when you look at the sales, right, that was around $500 million. They bought it for $1.2 billion. So presumably the goodwill that was added, you'd think of around $600 million, $700 million, that would make sense. So that means that goodwill and other intangibles increased besides, not including the purchase of ECS by, sounds like an enormous amount, $500 million. So let's see what's going on exactly. So when we look at the total, right, we're talking about $750 million of net intangibles, right, in 2019. And in 2018, it was only at $178 million. And in terms of what was acquired, we're talking about $655 million. So clearly, it is really, we're talking about $700 million being acquired as goodwill, which I just mentioned, from this foam mattress company. And that happened in 2019, and that's what this massive increase is. But this is, this doesn't account for everything, right? We said that there was a $1.1 billion increase, and now we're seeing only $700 million increased here. And once again, we don't have to dwell on this too much, but let's just see what we're talking about in terms of the increase. So, we're talking about the customer-related intangibles, so that's $600 million versus $200 million. And, I don't know exactly what this is, but they mentioned we mentioned in our last video that one of the things they saw from this foam mattress company was the customer mix. And so they're seeing that as very valuable. I assume, I don't know, but I assume that they're talking about the fact that they're getting all these new customers and they have access to them. And so they see that as an intangible. They see that as something they can't just buy, right? And you can't just value. In terms of technology, that was a huge boost. So that's what they're looking at in terms of what they bought. And of course, patents and trademarks increased. They almost doubled compared to a year ago, 65 million to 133 million. And that makes sense. Presumably the foam company they mentioned came along with a lot of patents and trademarks. Okay, so when we're looking at liabilities and equities, just a few things to point out. Total current liabilities is about $1 billion, which is a little bit scary. But the vast majority is the accounts payable, which you mentioned, which was $500 million. And it's only a $100 million increase from the previous year. So nothing too drastic as far as I can tell. In terms of long-term debt, you can see this $900 million boost, and that was once again because they had to buy the foam mattress company. You see how much this foam mattress company comes in to this whole picture. It was a massive mattress purchase, and it is affecting everything. Now, in terms of net earnings, we already mentioned they went up year from year. In terms of depreciation, that kept going up year to year. Of course, they bought a new company, and they're investing in more stuff, and so it makes sense that depreciation would continue going up regardless. And in terms of accounts and other receivables, so you can see 2017, 2018, it went down. It went down by a substantial amount. Now, I don't know, does that mean that they shortened the window? Or more people were paying? I'm not entirely sure why the receivables technically went down. Maybe they just got that cash up front from, their customers. It's a little bit hard to tell, but to me, it would be a little bit of a red flag. And in 2019, we don't really know what's going on because they bought the foam mattress company. And so, yeah, their accounts and receivables, of course, they went up a substantial amount because you have a whole new business that has all these new accounts. So, once again, it's a little bit hard to tell what's going on. It's being obfuscated just ever so slightly by this foam mattress acquisition. And same thing with inventories, right? Their inventories are going down, and then all of a sudden they go up because of this purchase. So, it's hard for me to make heads or tails of exactly what's going on. And so that adds a little element of risk here in terms of feeling comfortable with the numbers. Nevertheless, the net cash provided by operating activities, so you can see 2017, 2018, a little bit stagnant, and then 2019, that boost, that $200 million boost. Now, in terms of additions to property, plant, and equipment, you can see it's pretty steady, so that's a pretty good sign as far as I can tell. Now, in terms of, their inventory and that $600 million worth of inventory, a huge chunk of it is raw materials and supplies. And to me, that's a really good sign. It means that, for example, compared to finished goods, which is the same amount. So finished goods, what happens if spring mattresses go out of style? You might lose an enormous amount of value. Whereas raw materials, it's hard to imagine that they'll go out of value, even if they're not going to be used by this company. So what? So steel's used by other companies. Springs are used by other companies too. They don't just necessarily lose value so easily. Okay, so now let's start looking in terms of the sales by not just by the segment, but also by the specifics. So in terms of residential products, we can see that the bedding group, right, it was going up from 2017 to 2018. It wasn't so stagnant as I had originally thought. Of course, there's this big boost, but that's primarily from the foam mattress company. So once again, we don't know what would have happened without that purchase. Now, in terms of fabric and flooring, so we can see that's also going up. So, that's also a little bit of a positive there. Now, in terms of furniture products, so we can see that consumer products, they in 2017 to 2018, there was a boost there, and then all of a sudden 2019 it went down. Well, we already know that they were, planning to exit and control some of those segments, right? That's what the 10K already mentioned. And so maybe that's what we're seeing here. Same thing with home furniture group, right? You can see that 2017, 2018, right? Presumably they're pulling out of this fashion beds segment, and they continue to in 2019. And so you're seeing less and less sales. But then again, they weren't having a lot of sales, and the cost of these items was too much. And so, it just adds all these expenses, and they felt they should get out of them. Now, in terms of work furniture, you can see that those were continuously going up. It wasn't just a little blip in 2019 that we mentioned went up. It was also going up since 2017. So, to me, that's a really nice positive when we're looking at these more finely detailed points. And that's why it's really important to go deep into this stuff as well. That's what I think. Now, in terms of the automotive and aerospace, so first in terms of automotive, you can see it goes up and then it goes back down in 2019. I mean, not to where it was in 2017, but still, it goes up and then it comes back down. It's not steady, strong. That's the point. However, aerospace, on the other hand, was steadily going up. It went up 11 million and then it went up another, 9 million. So that to me is a positive there. Okay, so now when we look at total foreign sales, we can see that it's a substantial amount. We're talking about $1.5 billion is coming from the foreign section, and $500 million is really coming from Europe, $500 million is coming from China, and then $500 million is coming from North America. So from my perspective, it's really well spread out, their foreign sales, and so that's a really nice positive. It's a little bit scary that some of it's happening in China. I'm not anti-China, it's just, it's a little bit of a dicey area right now. What's happening with it, in terms of, whatever. You follow the news, hopefully, you know that things are a little uneasy over there. And Europe also has its troubles. North America seems to be doing pretty well, and that's why it's nice to be diversified, because presumably when China's done with their troubles, and maybe Europe's being hit, well, North America hopefully is not doing as badly, and these things will obviously and hopefully balance out. So that's one of the nice positive advantages to this company. And of course, it's a 30% as we mentioned in our first video. Now, in terms of foreign tangible long-lived assets, you can see most of it is in Europe, and so make of that as you will. I personally think that's a positive because I think Europe is more stable compared to probably most of the world. So to me, that's a positive, but Europe has its troubles, Brexit and the EU as well. Okay, so let's look at the 10Q, the first quarter results that they posted, and then we'll get into the earnings call, and we'll get more of a feeling what happened since the last, 10K was released. Okay, so if we look at the cash and cash equivalents, it's almost doubled since 3 months before, right, from $250 million to $500 million, so that's pretty positive. Now, in terms of the buildings, we can see it went from $720 million to $696 million, so almost $25 million decrease. Well, we already mentioned in the previous part of this video that they sold a piece of real estate, or they were planning to sell a piece of real estate, so clearly they were successful. And so that's actually, to my mind, pretty positive, especially since I would imagine that it would be hard to sell in this situation. So presumably that was all set up and done before everything, went down the drains, as they say. Now, in terms of current liabilities, we can see that it increased by $500 million. So that cash and cash equivalents presumably is just from this long-term debt. So that's a little bit sad. I was hoping that there was a better reason for it. Nevertheless. Okay, so in terms of net trade and sales, so we can see comparing to 2019 to 2020, there's a $100 million drop-off. Doesn't seem that big of a deal. In terms of gross profit, okay, it's a little bit smaller. That's not so bad compared to the fact that there's $100 million less of trade sales to only be down, $10 million roughly in gross profit. That to me is pretty good. Now, in terms of selling administrative expenses, right, those stay constant, sadly, and regardless of whether you sell more or less sometimes. And so earnings before interest and income taxes, right, you can see there's this $18 million dip, sadly. Okay, so in terms of their first quarter, they see they had a 9% decrease compared to 2019. However, the organic sales decreased 12%, right? So that 9% is really, in terms of sales, when you look at it from that perspective, it's 12%. And there was this planned exit of a business, and it had, due to the restructuring activities, it reduced trade sales 3%. So maybe that's adding up to some of those organic sales. Nevertheless, not a good sign from my perspective. Now, in terms of bedding products specifically, organic sales were down 15%. That's even worse, right? So sales volume decreased 11%, and that's, though they say, because they exited volume from fashion beds and the closure of a drawn wire facility. Nevertheless, the ECS, the foam company acquisition, added 4% to sales. So, clearly, from my perspective, a positive purchase in terms of the company, but somewhat synthetic. They didn't really do it from the business itself growing. They just purchased a different business. Now, in terms of foreign currency translation adjustments, so you can see that it clearly went down about $70 million. And, we mentioned this, I think, in the JP Morgan video, that when there's all this world unrest and uncertainty, people flock to the U.S. dollar as a safe haven, right? They think the U.S. dollar will it'll do well, and it'll maintain its value. And so that means that when companies have this money in foreign markets, well, when they translate it back to U.S. dollars, things can just go out of whack just because it looks like they're selling less or whatever, they have less money just because it's in a foreign currency. However, if that foreign currency stays in those countries, it doesn't really change that much. Okay, so if we look at restructuring plans, so you can see in terms of the end of March 2020, you can see they spent very little money in terms of restructuring, and so that's pretty positive. They mentioned by 2020 it should all be done, specifically the end of 2019, I think they said, but in terms of 2020, clearly they're not having these additional expenses to muddle things. So that'll be another bonus from my perspective in 2020, right? They'll have fewer of these costs, and going forward, hopefully they'll have less restructuring costs. Okay, so now let's take a look at this. So this is really important. We're talking about the fact that and we mentioned this, I think, in the first video, they have a deal with the banks about how much leverage compared to earnings. So how much debt can they have compared to earnings? So the calculation of the ratio now subtracts unrestricted cash from the consolidated fund indebtedness. And so, that means the amount of debt that they have is going to be considered less automatically. And they were, it was changed from 4.7 to 1. That's the new ratio, right? So originally, I think the ratio was 4.25, and then it went down to 3.5 That's what it should be now, and yet now they're allowing 4.75. And so that pretty much means they can have much less earnings, right? Their debt, we mentioned before, that went up about $500 million, I think. So first of all, they're increasing their debt, but not really, because the unrestricted cash will cancel that out, I suppose. But presumably they're increasing their debt, because if they use that cash. So first of all, they're increasing their debt, but also they're going to have much less earnings, just because they're going to have fewer customers. And so it's important for this ratio to be able to be increased, right? Because if it's not increased, so then the bank can pretty much say, we want our money, we want it now, sell everything you have to be able to pay us. So that's a little bit scary. And also their total secured debt limit was changed from 15% to 5%. So clearly the bank is trying to have a little bit more, seems like more control, I suppose. Or I don't know if this means, a secured debt, first of all, means, is their collateral, for example. So does this mean that they still have the same amount of money, but they have less secured debt that needs to be used to access it? Possibly. I don't know. To me, it's not such a big deal, but clearly the bank is trying to protect itself regardless, and the company, and in terms of its credit limits. Also, the credit facility also has an anti-cash hoarding provision. So, presumably they don't want these companies taking out cash that they don't really need. Right, so once again, the bank trying to really control what's going on, as much as they're loosening, some of these technicalities, they're still trying to keep themselves protected. So that's really important. So on one hand, you'd think they would never force these companies to cash in and pay off their debt because it goes through this, ratio, because you're thinking you're just going to destroy your customer who is going to pay back as much as they can. When things turn good, well, maybe the bank has to protect itself and it has to start calling in debts eventually. Hopefully that won't happen, both from the bank perspective and also from specifically this company perspective, but it is really important to mention. Okay, so now they also mention the fact that they have limited productions due to everything that's happening in 3/4 of their facilities around the world, so that's not a great sign, but they're obviously still running, it's just limited. And a small number of their employees, sadly, have tested positive, and so they have to close those plants and clean them, and pretty much that's going to be their approach if anything happens in any of their plants. So on one hand, they're taking this responsibly, which I think is really positive. On the other hand, right, any positive tests could just shutter this company unless they change their policy. Okay, so now for some more bad news. They got a credit rating downgrade, right? So one rating agency lowered them by a notch, but they were changed to stable. And then they got another rating agency who also lowered their long-term and short-term ratings by one notch, once again with a stable outlook. And pretty much what's going to happen is they're going to have higher interest costs the more and more this gets downgraded, which is not a good sign for a company that's going to need access to money to help them keep running. And so if we look at Moody's, for example, they were lowered to a Ba2 from Ba1. And what do they need to get the upgrade or the downgrade? So pretty much to have the upgrade, they have to have the consistent organic revenue growth. So not just buying another company. No, their sales within the company have to grow, which, hopefully that should happen. But it's, once again, we mentioned that this company looks a little bit stagnant when you take out the purchases of other companies. So clearly Moody's is noticing that. Also, they're saying the debt to earnings before interest, tax, depreciation, and amortization has to be below 2.5. Right now, they are allowed to go up to, I think, 4.75, we mentioned. So clearly the bank is giving them a lot of, room. However, Moody's, is pretty much saying if you want to be rated well, you have to keep this ratio low. And I think it might take a while before the company to get there, but we'll see in terms of what happens to earnings and how much they can pay down their debt. And, if their financial leverage goes above 3.5 times in terms of that ratio, they get another downgrade, which, that's pretty scary. Okay, so now if we look at another thing they mentioned, they said that 2020, their steel costs have been further deflating, so that's a pretty good sign. And in early 2020, these metal margins began to compress. And so you want the margins to stay wide, right? That means that they're buying lower, selling higher. But nevertheless, they said as much as they're compressed, they're wider than usual. So that is at least is good. Okay, now just to go back to these anti-dumping petitions, they mentioned that the mattresses in China were benefiting from subsidies, which we mentioned was presumably what the anti-dumping policy was from. And they're expecting final determinations in the first half of 2021. I assume with this government, they're going to get some sort of anti-dumping tariffs. On the other hand, you never know what's going to happen in terms of negotiations. So it's always a little bit hard to tell, but I would lean towards the assumption that there's going to be tariffs. Okay, so in terms of their accessibility to cash, so here they talked about how they're bringing back approximately $150 million of foreign cash before year end. And so that's pretty positive. Sadly, the US dollar is doing better, at least sadly for Leggett Platt, I should say. And so that means they're going to have to take more foreign currency to get to that $150 million. But clearly they're trying to pay down some of their debt, I think. I think that's why they're doing it, hopefully. And, they're being cognizant of that ratio and trying to keep it down. Okay, so when we look at the earnings call, we notice a few interesting things here. So first of all, they say in the final 2 weeks of the quarter, they saw a steep and rapid sales decline. And so, they're talking about how their sales were roughly down 40 to 50%. So as much as we saw that, there's only $100 million difference in sales, well, that's presumably because in terms of, their first quarter, they were only affected by 2 weeks in terms of sales. And so that is going to be a staggering thing in the next quarter, from my perspective, if it stays that way. Now, they did mention that they felt that there was a low point in the first week of the second quarter, that was down 60%, but they've seen it recovering since then. So it's a good sign. It means that they've hit the bottoms. The question is, where is it going to stay? And right now they're down, or I don't know right now, but their sales in the third week of the quarter, as far as they're saying, are still down approximately 45%. So it's not like everything is a V-shaped as of yet. I don't know what's going to happen, obviously, but I'm just saying as of yet for this company, they haven't seen that, complete recovery. And, even if this were being posted now, right, at the time this was posted, presumably people weren't going back to work yet. But presumably this company is going to lag the economy substantially, right? Why? Well, because first of all, people have to move before, as we mentioned before, presumably people buy mattresses when they move. So that's going to be a little bit delayed, in terms of everything going back to normal, people feeling like, okay, they can purchase a house now and they feel like a little bit more stable. Then on top of that, they have to go to a mattress store. So that mattress store already has inventory, so they might not rebuy more inventory. And of course, they're buying from a company, let's say Sealy or some other company, which itself has inventory, and they don't know if they're going to ask, Leggett Platt to build them more mattresses yet necessarily. So, there's all these steps that will delay how quickly they'll recover. And on the same flip side, how delayed it was for them to see themselves getting hit, right? They only got hit in the final 2 weeks of the first quarter. Okay, but, nevertheless, we'll see what happens. Okay, so they mentioned that they're already trying to reduce their fixed costs, which is pretty good. Also, they mentioned they had a 50% salary reduction for their senior executive officers. I thought that was pretty nice of them. And they reduced their fixed costs by this year by approximately $130 million to $150 million. Now, to be fair, just in terms of that salary reduction of senior executive officers, right, they hold an enormous amount of shares and this company pays dividends. So it's not, I have no idea at the end of the day how much they're being paid or not paid. But obviously, a 50% salary reduction is, from my mind, pretty impressive. Okay, so, Carl Glassman also mentions that they're, making hospital beds and medical mattresses, ventilators, providing wire and fabric for face mask producers. They're also using their internal resources to do face mask production. So they're really trying to push forward and help people produce hand sanitizer. And besides that last one about hand sanitizer, you could imagine that this business is possibly opening new avenues for customers, right? Hospital beds, medical mattresses. These are potential future customers that they could continue working with. Face mask producers who need wire, once again, I don't know if that will entirely affect their bottom line, but every little bit, from my perspective, helps. So, hopefully they're helping other people, giving them cheap prices and all these things to help people do their best in the United States. But nevertheless, hopefully that will turn around and help them just the same. Okay, so now when they talk about their aerospace, they said that they held up pretty well in terms of the first quarter. But going into the second quarter, they're mentioning that there's all these production cuts in terms of Boeing and Airbus, and they have no idea how that's going to affect them. I would hazard a guess that it's not going to be good. So you can see how Leggett & Platt is being hit across all their different operating segments, which to me, it's great that they're diversified, but it's a little bit sad that they're being hit in all the spots. Okay, so now they also mentioned that their steel costs will continue to stay somewhat muted, right? They don't really know what's going to happen, right? They might see a couple of months where there's a blip and then where costs do accelerate, right? Because maybe there's, some supply and demand issues. For example, if the demand picks up quicker than supply does, right? So there's going to be cost increase, which is going to affect their bottom line as well, sadly. Although you never know. They also say that in terms of their stuff in China, that most of the areas are returning slowly in China, which, on one hand, it's good that they're returning. On the other hand, things are happening cautiously. And, so what's going to happen in North America? Well, sadly, things might be slower than people expected, in terms of this V-shaped or U-shaped or whatever shape recovery things are happening. Okay, so we've been talking about this company for a long time. Let's just try and wrap it up really quickly. They clearly have a lot of struggle. They're stagnating. They're buying companies to try and achieve growth, and they might legitimately get that growth. That to me is, a little bit of a bigger risk than a stable company like Coke, which, pays a dividend and is continually growing or seemingly growing. So, to me, I would want a little bit more buffer. I'd want this price to come down maybe even lower, and I think it will simply because of these delays, which we mentioned. So assuming the economy does recover really fast, I don't think that this company is going to see that recovery as quickly as, other companies will, and I think that'll negatively affect the stock price here. I think that they might, I don't entirely know if they'll be hitting Q3, but Q2 is going to be seriously rough, I think, and Q3 might still not be so great. We'll have to see. Well, and the real question you have to ask yourself is, are people going to come back and buy mattresses? Are they going to be moving? Is the housing market going to come back as quickly as, let's say, the economy? It's hard for me to tell. Obviously, real estate agents always tell you that the market's coming back, it's booming. But from my perspective, I think a lot of people are going to be hesitant to buy a house. But I could be wrong, and maybe housing prices will fall, and people will snatch them up while they can. I'll leave that to you to decide. But I think that we covered this company pretty well, pretty in depth. We'll look at the insider trading and see what they're doing. I think it's pretty interesting, a little bit scary right now, but nevertheless, really important to look at. Okay, thank you so much for watching. Please like, comment, subscribe, and I really appreciate the positive comments that people have been leaving, so thank you so much for that.